No, but while I was on Facebook, I came across this ad from Jessica Morehouse, who has a Canadian podcast for an easy ETF portfolio using BMO's ETFs. And knowing that big bank advisors and brokers tend to over diversify their clients' portfolios through hundreds of stocks, I thought that I would dig in to see what kind of portfolio composition we would actually end up with if we did invest in an equally weighted average across these 5 ETFs. So let's just quickly look at these 5 ETFs, and then I will summarize the portfolio at the end. And just a note, I have gotten all of the info from these ETFs directly from BMO's website. So the first ETF here, ZCN on the TSX, which is BMO's S&P TSX Capped Composite Index, which essentially aims to replicate the return of the TSX index. And like the Canadian market, it is heavily weighted toward financials and energy stocks. The next here we have ZSP on the TSX, which is BMO's S&P 500 index, and this just tries to track the S&P 500, or in other words, the US market. Then we also have here ZEA, which is BMO's MSCI EAFE index, which tracks the markets in Europe, Australasia, and the Far East, which is what EAFE stands for. And then as well, we have ZEM on the TSX, which is BMO's MSCI Emerging Markets Index, which is pretty self-explanatory. It's just emerging markets. And then last, we have BMO's Aggregate Bond Index ETF, which invests through Canadian government and corporate bonds. So, in summary here, if one was to invest in these 5 ETFs based on an equally weighted average, you would end up with a portfolio that holds over 2,300 stocks and just under 1,500 bonds, with an asset allocation of about 80% in stocks and 20% in bonds. Now, first off, with our philosophy of trying to find the next Boyd, Expel, Hammond Power, Water Furnace, absolute game changers for clients' portfolios, I think that this ETF portfolio is way over diversified with over 2,300 stocks. And in the words of Bill Gross, any good investment ideas that are in this portfolio are essentially being diversified away into meaningless oblivion. So even if one name provides a return of 500% or 1,000% or 10,000%, it really isn't going to make the needle move for your overall portfolio. Now, number 2 here, on the fees being paid for holding these ETFs, generally, I do think that they are reasonable. And you can see here, I made a few simple calculations using the weighted average management expense ratio, or MER, which is about 0.148%. And based on some hypothetical amounts that have been invested across these ETFs, if you invested $100,000, you would pay about $148 per year. Or if you invested $1 million, you would pay about $1,500 per year. Now, for the sector and geographic breakdown of the stocks across the portfolio, I think that financials are a little overweight here at just under 20%. And realistically, I think that I would want my portfolio to have more than 25% exposure to the US market. I mean, maybe that's just personal for my own self, as you know, the US is a leader in tech innovation. And I would likely want to limit my exposure to other locations in the world, such as China, which makes up 7% of the portfolio. And although it's quite small, also Russia, which makes up just under 1% of the portfolio. So all in all, for an investor that just wants to ride the markets of the world, I do not think that this portfolio of ETFs is bad. But for someone who actually wants to build a portfolio that isn't over diversified and can position you for life-changing stocks, I would advise that you avoid, making a portfolio of ETFs like this. So yeah, I'll open it up to you guys. See if you guys have any comments on this.
It's a couple things. If your goal is just to mirror the markets globally, it's fine. This portfolio is fine. That's what you can do here. Yep. Number 2, don't pay an advisor for this advice. This is something you do by yourself. Don't pay 1% in terms of an advisor, because Brennan talked about the fee there. Their advisors will put you into this portfolio, and if you got $1 million portfolio, or even $100,000 portfolio, $200,000 portfolio, you got a 1 to 1.5% overlay fee on that. So it's $1,000 on, 100,000, $2,000 on 200,000. Even if it's 1%, $10,000 that you're going to pay out for advice to go into a portfolio such as this. You certainly don't need much advice to do this, because you're just mirroring the markets. And at least the fees are low, which is good.
Yeah.
But so don't pay an advisor. But make no mistake, if your goal in the market is to try to beat the market, there's no way this structure can do that. So if you just want to set it, forget it. If that's what you want to do, have some participation in the markets, you could use a structure like this. There's probably other ways that we might want to structure it, but this is fine. It's defensible in that respect. But if you have any goal of trying to beat the market return over time, this would not be the way to go about it, in my opinion.
Agreed.
Well, no, I mean, it's not your opinion.
Yeah, it's not.
There's
it's not an opinion. It's a fact.
Ways. Like, I have no problem with this portfolio as a passive investment portfolio. I've said to people, I say, probably you can do it with 2 to 4 ETFs. Some people want to have ETFs that give them direct exposure to foreign markets outside of North America. By investing in the S&P 500 index, you are investing in a lot of companies that are global. So you if you want to really simplify it, you could probably do that with just a Canadian and a US, and then maybe a bond ETF if you want bonds. But there's different ways in terms of strategy of investing in the market. That one way to break it down would be passive and active, right? So a passive investor is somebody who just wants to mirror the market, right? The market goes up, they go up. The market goes down, they go down by about the same amount minus fees, right? So passive investing is for somebody who just doesn't want to they don't want to do any individual stock purchases or sales. They just want to, buy their mutual funds and coast with the market up and down and not have to look at it or think about it really that much. You don't buy and sell, you don't trade in and trade out. It's a long-term strategy. You just go with the market. Nothing wrong with that if that's what you're looking for. Active investing is when you want to actually outperform the market, and you do this almost always through buying and selling individual stocks, right? So active investing gives you the opportunity to generate outsized returns, also the risk that you will underperform the market, but certainly the opportunity to outperform the market and the opportunity to invest in some very unique companies that are doing incredible things in terms of solving problems for society, right? So that's an active investing strategy. Buying ETFs is not an active investing strategy. Buying individual stocks is an active investing strategy. So it really comes down to what you want as an investor. If you're looking to generate those market beating returns and invest in individual stocks or individual themes that you think are going to essentially propel society forward, then you're going to want to focus on individual stocks, or at least with a portion of your portfolio. Now, what some investors will do is they'll do what's called a hybrid investing strategy, and they'll take a portion of their portfolio, they'll put it into ETFs, such as some of these, they'll take a portion of their portfolio, they'll actively invest it. And that way they're getting the opportunity to invest in some great companies while they're remaining widely diversified with the rest of their capital. And what that mix looks like really depends on the investor. It might be 80% passive, 20% active, 50-50, or 20% passive, 80% active. Really just depends on the individual investor. So, but the thing to really understand is that, you don't want to mix, in my opinion, active investment with the same capital. You don't want to try and get wide diversification and invest actively at the same time. If you want to get wide diversification, go with an indexed ETF, low-cost indexed ETF. If you want to outperform the market, you need to focus your capital strategically in strong areas and strong stocks. And when it comes to mutual funds, there are a lot of mutual funds out there that will try to outperform the market while also being widely diversified, and they almost always fail long-term, but they charge higher fees due to their effort to try and outperform the market, which they tend almost always not to do. So, you could, if you have, say $1 million, you can take a portion of that, put it into ETFs, take a portion of that, put it into active management.
Something... Yeah. And again, what I was stressing is, if you're going to use a strategy like this, You do not need an advisor charging you 1%. If you like, I've seen several portfolios where it's $1 million, $2 million, and they have somebody charging 1% to do this.
Yeah, no,
That is
you
not.
don't need you don't need an
Do
advisor.
not do
You can
that.
buy
You're
these
just getting
ETFs
fees.
easily in a discount brokerage, and you can just set it up even so that you're purchasing a certain amount every month
Automatically,
or every quarter. And they're extremely easy to buy, so you don't need to pay an advisor. You know,
Yeah, so
1%.
you're
Buffett has
basically
talked about
cutting
that before.
yourself. You're cutting yourself off at the knees because you get the benefit of these are they're low cost. But if you overlay a 1% portfolio fee on top of that, you're basically cutting that benefit out, and you're going to significantly underperform the market because of that fee. So if you're going to do this, you can do that yourself with a discount brokerage, and that's what we tell people all the time. And Aaron said it's active versus passive. If you want to beat the market, you have to use a different strategy. I mean, that's obviously what we provide to clients on a
Yep, and you can get
annual
pretty good
basis.
diversification in a passive strategy with even just 2 or 3.
Yeah.
ETFs.
I even found it interesting that like some of these funds here also held like
Funds.
11. Yeah, exactly. It's like fund of
Yeah.
funds. 11.4% of this is in iShares emerging markets. I mean, it's like you could just go maybe buy the iShares if you wanted. I mean, depending on the MER. Another question that I'd have too is I'm not pointing fingers. I have no idea if she does have some partnership with BMO or if there is, but that would be something that I would like to know as well, is whether this is kind of marketing with BMO as well. But
Yeah, it could be disclosed right there, and
Yeah,
and I think there's just some like good educational work on this stuff that's being done. But this portfolio, it's your portfolio, but don't pay an advisor to get this portfolio. In my opinion, you don't need that. And if you want to beat the market, you need to structure your portfolio differently. And we do seminars on that all the time.